Welcome to your guide on building reliable passive income with Undervalued Dividend Kings. If you're looking for safe, growing dividends to secure your financial future, you're in the right place. Today, we're diving into 3 Dividend Kings trading below their fair value. These are perfect for long-term income investors like you. Stick around, because we're going to break this down in a way that's easy to understand. No jargon. No fluff, just clear facts and insights. Let's start by explaining what a Dividend King is. A Dividend King is a company that has increased its dividend payout every year for at least 50 years. That's half a century of consistent dividend growth through recessions, wars, and market crashes. These companies are the gold standard for reliability and financial stability. They're not just surviving. They're thriving year after year after year. I focus on Undervalued Dividend Kings because they offer a rare opportunity. You get steady income plus the potential for stock price appreciation. When a stock is undervalued, it's like buying $1 for 70 cents. Over time, the market often corrects this, rewarding patient investors. Our 3 picks today are Dividend Kings that are trading below their intrinsic value. We'll analyze each one, looking at their business financials and why they're a great buy now. Before we dive in, a quick note. This is not financial advice. Always do your own research or consult a financial advisor before investing. Now, let's get to our first Dividend King, PepsiCo. PepsiCo is a global leader in food and beverages, with a portfolio of iconic brands. Think Pepsi, Mountain Dew, Gatorade, Frito-Lay, and Quaker Oats. This company has been a Dividend King for 53 years. That's 53 years of raising its dividend, no matter the economic climate. As of April 2025, PepsiCo's dividend yield is around 3.5%. That's well above the S&P 500 average yield of 1.2%. PepsiCo's payout ratio is about 65%, which is sustainable. This means they pay out 65% of their earnings as dividends. The remaining 35% is reinvested into the business. Why is PepsiCo undervalued right now? Let's look at the numbers. PepsiCo is trading at a forward price-to-earnings ratio of 18.8. Compare that to its competitor, Coca-Cola, which trades at 24.2. The consumer staples sector average is 23.2. This suggests PepsiCo is cheaper than both its peers and its sector. In February 2025, PepsiCo announced a 5% dividend increase. The new annualized dividend is $5.69 per share. This shows management's confidence in future cash flows. PepsiCo's revenue is split 60% food, 40% beverages. This diversification reduces risk compared to beverage-only competitors. Geographically, it's balanced, with half its revenue from the US and half international. This protects it from regional economic downturns. However, PepsiCo has faced challenges, like slowing sales growth. In 2024, volume declines hit the beverage segment due to price increases. Consumers pushed back, opting for cheaper alternatives. This caused the stock price to stagnate, creating the undervaluation we see today. But PepsiCo is adapting, focusing on innovation and cost control. For 2025, analysts expect 8% earnings per share growth. That's a solid rebound, making now a great time to buy. Its undervaluation is a bonus for investors seeking both income and growth. Next up, let's talk about our second Dividend King, Kimberly-Clark. Kimberly-Clark is a consumer staples giant known for brands like Huggies and Kleenex. It's been raising dividends for 52 years, a remarkable streak. Its current dividend yield is 3.8%. That's one of the highest among Dividend Kings, making it a passive income powerhouse. Kimberly-Clark's payout ratio is around 70%. This leaves room for reinvestment while supporting dividend growth. The company trades at a forward price-to-earnings ratio of 17. That's significantly lower than the consumer staples sector average. This low valuation is due to sluggish growth in recent years. Over the past 5 years, sales grew only 6.8%. Operating income grew even less, at 5.8%. This lack of growth has kept the stock price down, but here's why that's an opportunity for income investors. Kimberly-Clark's products are essentials, diapers, tissues, and personal care items. Demand for these is steady even in economic downturns. This makes Kimberly-Clark a recession-resistant business. The company is also streamlining operations to boost profitability. In 2024, it cut costs and improved supply chain efficiency. These efforts are expected to drive modest growth in 2025. Analysts project earnings per share growth of 4 to 5%. While not spectacular, this supports continued dividend increases. Kimberly-Clark's high yield and low valuation make it a compelling buy. It's ideal for investors prioritizing income over rapid stock price growth. Now let's move to our third dividend king, Cincinnati Financial. Cincinnati Financial is a US-based insurance company founded in 1950. It offers commercial, personal, and life insurance, plus annuities and bonds. It's been a dividend king for 65 years, one of the longest streaks. Its current dividend yield is 2.4%. That's lower than our other picks, but still above the market average. The payout ratio is around 50%, leaving plenty of room for growth. Cincinnati Financial trades at a forward price-to-earnings ratio of 20. That's below the financial sector average of 22.5. This undervaluation stems from market concerns about interest rates. Higher rates can pressure insurance companies' investment portfolios. But Cincinnati Financial is well positioned to navigate this. It has a diversified portfolio of bonds and stocks for income generation. In 2024, it reported strong underwriting results, boosting profitability. Its combined ratio, a key insurance metric, was below 100%. This means it's earning more in premiums than it's paying in claims. For 2025, analysts expect earnings per share growth of 6%. This supports future dividend hikes and potential stock price gains. Cincinnati Financial's conservative balance sheet adds to its appeal. It has low debt and strong cash reserves, reducing financial risk. This makes it a safe bet for income-focused investors. Now, let's compare these three dividend kings side by side. PepsiCo offers a 3.5% yield and global diversification. Kimberly-Clark boasts a higher 3.8% yield. Cincinnati Financial has a 2.4% yield but a longer streak. All three are undervalued compared to their sector averages. PepsiCo is best for investors seeking growth and income. Kimberly-Clark is ideal for those prioritizing high yield. Cincinnati Financial suits those wanting stability and a conservative approach. Together, these stocks can diversify your income portfolio. They span consumer staples, personal care, and insurance sectors. This reduces risk, as they're not tied to one industry. Let's talk about why dividend kings are so attractive for passive income. First, they offer stability. 50 years of dividend increases is no accident. These companies have strong management and resilient business models. Second, they provide growing income. Your dividends increase over time. This helps combat inflation, preserving your purchasing power. Third, undervalued kings offer capital appreciation potential. As the market recognizes their value, stock prices can rise. But are there risks? Of course. No investment is risk-free. For PepsiCo, consumer trends could shift toward healthier options. This might hurt sales of sugary drinks and snacks. Kimberly-Clark faces competition from private label brands. Cheaper alternatives could erode market share. Cincinnati Financial is sensitive to interest rate changes. Rising rates could impact its investment income. However, these risks are manageable due to their strong fundamentals. Their long histories prove they can adapt to challenges. How can you invest in these dividend kings? It's simple. Open a brokerage account with a platform like Fidelity or Vanguard. Search for the stock tickers: PEP for PepsiCo, KMB for Kimberly-Clark, and CINI for Cincinnati Financial. Place a buy order and you're now a shareholder. You'll receive dividends quarterly directly into your account. Consider reinvesting dividends to compound your returns over time. This strategy, called DRIP, can significantly boost your wealth. Let's look at an example of how this works. Suppose you invest $3,000 in each of these stocks. With PepsiCo's 3.5% yield, you'd earn $105 annually. Kimberly-Clark's 3.8% yield gives you $114. Cincinnati Financial's 2.4% yield delivers $72. That's a total of $291 in passive income per year. And that's just from a $9,000 investment. Over time, as dividends grow, so will your income. If these stocks appreciate to their fair value, you'll also see capital gains. This combination of income and growth is what makes Dividend Kings so powerful. But how do you know if these stocks are right for you? Dividend Kings are best for long-term investors. If you're looking for quick gains, these might not be the best fit. They're ideal for retirees or those building wealth over decades. They're also great if you want low volatility and predictable income. These stocks tend to hold up better during market downturns. That's because their businesses are built to weather economic storms. Let's recap what we've covered so far. We've introduced 3 undervalued dividend kings: PepsiCo, Kimberly-Clark, and Cincinnati Financial. Each has a long history of dividend increases and strong fundamentals. They're trading below their fair value, offering income and growth potential. We've also discussed their risks and how to invest in them. Now, let's explore how these stocks fit into a broader investment strategy. Dividend Kings are a cornerstone of income-focused portfolios. They provide a steady cash flow you can rely on, but they shouldn't be your only investment. Diversification is key to managing risk. Consider pairing these stocks with growth stocks, bonds, or real estate. This balances income, growth, and stability in your portfolio. For example, this mix depends on your age, risk tolerance, and goals. Younger investors might lean more toward growth. Older investors might prioritize income and stability. Another strategy is to build a dividend ladder. This involves buying stocks with different dividend payment schedules. For example, PepsiCo pays in January, April, July, and October. Kimberly-Clark pays in January, April, July, and October too. Cincinnati Financial pays in January, April, July, and October as well. To create monthly income, add stocks that pay in other months. This ensures a steady cash flow throughout the year. You can find dividend calendars online to plan this. Another tip is to monitor these companies' earnings reports. Earnings reports show their financial health and future outlook. Look for revenue growth, profit margins, and dividend coverage. These metrics confirm the dividend sustainability. You can find earnings dates on company websites or financial news sites. Also, keep an eye on macroeconomic trends. Interest rates, inflation, and consumer spending affect these companies. For example, high inflation could pressure PepsiCo's margins. Rising rates could challenge Cincinnati Financial's investment, but their long track records show they can handle these challenges. Let's talk about taxes. Since dividends are taxable income, in the US, qualified dividends are taxed at a lower rate. This rate ranges from 0 to 20%, depending on your income. Holding these stocks in a tax-advantaged account, like an IRA, can reduce taxes. Consult a tax professional to optimize your strategy. Now, let's address a common question. Why not chase high-yield stocks? Stocks with yields above 7% can be tempting, but high yields often signal risk, like unsustainable dividends. Dividend Kings prioritize sustainability over flashy yields. Their moderate yields are backed by strong cash flows. This reduces the chance of dividend cuts, protecting your income. Another question: should you invest in Dividend King ETF instead? There's no ETF that focuses solely on Dividend Kings, but the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBLE, is close. It holds stocks with 25 years of dividend increases. Many Dividend Kings are included, but it's broader. ETF offer diversification but may include overvalued stocks. Picking individual stocks lets you focus on undervalued opportunities. It also avoids ETF fees, which can eat into returns. However, ETF are great if you prefer a hands-off approach. It's about what fits your investment style and time commitment. Let's discuss the broader market context for 2025. The US market is trading at a slight premium per Morningstar. Growth stocks, especially in tech, have driven recent gains. Dividend Kings, however, have lagged behind. This creates undervaluation in value stocks like our picks. Analysts expect modest market growth in 2025. Value stocks could outperform if growth stocks cool off. Geopolitical risks and trade policies could create volatility. Dividend King's stability makes them a safe haven in uncertain times. Let's wrap up with some final thoughts. Investing in undervalued Dividend Kings is a proven strategy. You get reliable income, inflation protection, and growth potential. PepsiCo, Kimberly-Clark, and Cincinnati Financial are top picks for 2025. Their low valuations and strong fundamentals make them attractive. Don't just take my word for it. Do your own research. Check their latest earnings, read analyst reports, and assess your goals. Investing is personal, and your strategy should reflect that. If you found this video helpful, give it a thumbs up. Subscribe for more videos on passive income and investing. Share your thoughts in the comments. Which Dividend King is your favorite? Thanks for watching, and I'll see you in the next video.